Welcome to Bulletin Bites, brought to you by Rural India, your quick roundup of the most important developments in law, tax, and business across India this quarter. India continues to show resilient growth, backed by strong domestic demand and active policy momentum. And with that backdrop, a lot has happened in Q1 2026 that businesses need to be aware of. Let's get into it. The Ministry of Corporate Affairs has launched the Companies Compliance Facilitation Scheme effective from April 15th to July 15th, 2026. This is a one-time cleanup window where companies can regularize overdue filings at just 10% of the usual additional fees. Inactive companies can also opt for strike-off or dormant status at minimal cost. If your company has had pending filings sitting around, this is the time to act. On the foreign exchange side, the RBI has overhauled the external commercial borrowing framework, expanding who can borrow and who can lend, removing the all-in cost ceiling and setting a clean 3-year minimum maturity period. Reporting is now event-based with a 7-day window, which makes the process much simpler. The Supreme Court in Hamsa Nandini Nanduri versus Union of India struck down the 3-month age restriction under the Code on Social Security 2020, granting adoptive and commissioning mothers 12 weeks of maternity benefit regardless of the child's age. The Ministry of Environment, Forest and Climate Change has introduced a uniform consent framework under which consent to operate remains valid until cancelled, eliminating renewals and reducing approval timelines for red category industries to 90 days. The Aluminium and Aluminium Alloy Products Order 2026, which has been issued on 11th of March 2026, mandates BIS certification for 17 categories of aluminium products, provides phased compliance timelines, allows limited exemptions, and prescribes penalties for non-compliance. The Central Board of Direct Taxes, CBDT, signed 219 advance pricing agreements in financial year 2026 alone, bringing the total to 1,034. That's a strong signal of growing certainty for multinationals operating in India. The CBDT has also proposed aligning APAs with the amended Safe Harbour rules, giving taxpayers more flexibility to move between frameworks. In a notable tribunal ruling, the Berry ratio has been accepted as a valid profit level indicator for benchmarking telecom services, reinforcing how crucial functional and risk analysis is when determining arm's length pricing. The Finance Act 2026 has brought some long-awaited clarity. Commission income earned from providing marketing or sourcing support services from India is now exempt from GST implications, a change many businesses have been waiting for. For exporters, especially those in SEZ dealing with geopolitical headwinds, certain goods are now exempt from customs duty even when sold domestically. Export obligation periods are being extended, and the remission of duties and taxes on exported products scheme has been extended to September 30th, 2026. Relief that was needed. Deferred customs payment for eligible manufacturer importers is now formally prescribed, covering April 2026 to March 2028. And under the India-UAE and India-Mauritius Free Trade Agreements, the 5th and 6th tranches of tariff concessions are now effective from April 1st, 2026. Finally, paying customs duty just got easier. Payment aggregators are now a permitted mode, expanding internet banking options from 23 to 41 banks and adding credit cards, debit cards, and even UPI as authorized payment methods. The new income tax framework is now live in India from April 1st, 2026. The CBDT has issued detailed facts and form-wise instructions to help businesses transition smoothly to this modernized, technology-driven tax regime. Now is the time to review your processes and update your systems. In an interesting judicial development, the Bombay High Court has ruled that pure cost-to-cost reimbursements made under cost-sharing arrangements between group companies with no markup do not constitute taxable income and are not subject to withholding tax. A clear and practical clarification for intercompany transactions. As we are aware that in April, organizations are deep in year-end book closures. Year-end closing focuses on ensuring that financial statements present a true and fair view. This involves thorough reconciliations across bank accounts, customers, vendors, and intercompany balances, along with proper recognition of provisions, accruals, and IGAAP adjustments. A disciplined close strengthens internal controls and sets the tone for confident decision-making throughout the year ahead. With this, we conclude our updates for Q1 2026 edition of Bulletin Bites. For deeper analysis, visit the full newsletter on our website. If you found this useful, share it with your network. Until next time, stay informed and stay prepared.